So, okay, we're getting ready to record. This is financial accounting, and we are going to work on chapter 3's coursework. Okay, so I guess I just lost it. Share went away. Okay, there it is. Sharing my screen so that you guys can see what I'm seeing on screen along with those in class. Okay, so I think, let me make sure I got Barry here marked before I forget. There he is on Zoom. All right. And I've been trying to put Zoom down just in case, so I don't see Mr. Gates yet. All right.
Captions are enabled.
Captions are enabled, yes. And the reason I want that is
No, they're not.
they're not. Oh, yes, I want to. Thank you. Thank you. Because, so let me make sure. Okay, captions appear usually. Remote layout. Okay. Come back to me. Come on. Okay, we're still recording. I don't see my captions.
They're popping up right now.
Do what?
They're popping up.
They are popping. Oh. Okay, well, okay. I usually see them down here somewhere, but maybe they're happening on another screen that I'm just not looking at yet. All right. So here we are in Cengage. Now let me open up my spreadsheet and I'll pass out what I want to work on this with you. Okay, so this chapter is called the adjusting process. The adjusting process. So last time we worked in chapter 2, the last step that we learned in the accounting cycle, you may not know it, but you're learning the accounting cycle. Okay, yes, you are. We have gone all the way through the unadjusted trial balance. Okay, unadjusted trial balance. So now that we have completed the unadjusted trial balance, now we are going to learn the adjusting process. And then when we're finished with that, we will do our second trial balance called adjusted trial balance. So we're getting there. Last I knew, this book says that we have 10 steps to our accounting cycle, and we're getting there. Okay, so we're just kind of getting ourselves ready. Okay, so this is from the book. Okay, and this is a pretty good resource. You might put at the top or highlight the fact that it's coming from chapter 3, right? So when you're working on things, you can pull out your notes. And I wish I could say that this shows up in the ebook really well, but unfortunately it doesn't as well as I like. So that's why I like to make copies. And I have made copies of the bigger problems. When we get there, I'll pass out those. I hope you guys find the copies that I made for you help. Because that way it's one less screen that you have to look at. Okay, so. Okay. If you weren't here last week, I may have some handouts for you if you weren't here. So I got them in here. I just haven't. All right, I'll put them over here. Okay, so the adjusting process. Let's take a look at this packet real quick. Okay, I am going to just walk through a little bit here. So those of you who, we'll just look at it right here on the screen. Okay, so we'll look at it in my spreadsheet here. Okay, so once again, we left off with an unadjusted trial balance. Okay, so that's what I say right here. Chapter 2, we ended with completing an unadjusted trial balance. Now we're going to learn what adjustments are, the process, and do those entries, and then we'll have another trial balance that's considered adjusted. Okay? Adjusted trial balance account numbers are used to create the 4 financial statements. So what we're doing, okay, so let me put a few notes here on the board too, or you can write on here. I want everybody to know, adjusting entries are to update the balance in accounts. It is not correcting something that's wrong. Everybody with me? Adjusting entries is what the main focus of like month end, year end, is different entries that we need to see if we need to make them to bring our accounts up to date with the right numbers as best we can so that we can produce financial statements that are meaningful and useful and have correct information, and not just correct, but updated. Okay, so here's where we're at. Okay, let's just take a look real quick. For those of you who are out on Zoom, on my spreadsheet here, we're looking at basically this. And I don't know why I got a hole. There it is. There it is. Okay. So we have 4 different kinds of adjusting entries. Okay. So number 1, and I'll do this kind of as a recap like I did today during class. The first one is called accrued revenue. Okay, accrued revenues. Well, the word accrued, I don't know about you, but I have never used that in my life other than accounting. Okay, so what accrued revenue, accrued means that it happened. Okay, happened. All right, it was complete, or sometimes we'll use the word used because there are accrued revenues and accrued expenses. All right, so the first one we're going to talk about is accrued revenues. Let's just read this. It says services performed but not billed. Okay, so if it's the end of the month, accounting may talk to sales, management and say, are there any jobs that we are finished with that we can bill customers for right now? Because we finished it during a given period of time, like during the month, during the year. So we want revenues and expenses to reflect the time period that they were earned, and the expenses were used and generated to help those revenue. Okay, so here's what you need to think about. Accrued revenue, I want your brain to think of accounts receivable. Okay, I want your brain to think of accounts receivable. So, bill, okay, bill or invoice. Remember, bill and invoice mean the same thing. Okay, just write a few notes about these. So, bill customers for earned revenue that we haven't yet, right? So like I said, if we find a job that we completed, but we need to go ahead and bill them, we want to make sure that the revenue reflects the accounting period that we're doing a month end or a year end for. Okay, so here is the adjustment. Okay, there are certain adjustments that are done on purpose. There's a list. Okay, there's a list, month end list. And when a business has month end, they try to keep a list of what accounts need to be looked at to make sure that the right adjustments are taken care of. So revenue's been earned, but we have not billed any customers yet. So what we're going to do is we're going to make accounts receivable go up as the adjustment. Okay, so let's put accounts receivable. So the adjusting entry will be accounts receivable going up and fees earned going up for the revenue account. So I am going to put the word revenue here. Make sure you know that fees earned is a revenue. Okay. Every adjusting entry, so let me put this down. Every adjusting entry affects two or one balance sheet account and one income statement account. All right, so one balance sheet account, one income statement account. And we can prove it with this one, right? Because AR is on the balance sheet, it's an asset. Revenue is on the income statement, okay? So there's our very first one. So we'll be looking for that one. And once again, it's revenue that we haven't recognized yet, but we have fully earned it. Okay, we have fully earned it. Let's go to number 2. This one goes kind of hand in hand with accrued revenues. It's accrued expenses. Okay, accrued expenses. So this is what it says, expenses have been incurred. The word incurred means that they've happened, that, okay, so, but have not been paid or recorded. All right, so this usually involves a payable of some kind. Payable, a liability payable. Okay, so, and the reason why I have you write some things down is because there's still something that goes in your brain better when you actually write a few things about this. So a liability, usually some kind of a payable. It might be accounts payable, it might be wages payable, it might be salaries payable. It's some kind of payable. So this is an expense that needs to be recorded, but we have not paid the cash for it yet, right? Expense needs to be recorded, no cash paid. Okay, so here's the adjustment. Okay, the adjustment is going to be the liability. So for example, accounts payable will go up and an expense account will go up, right? So let's see if we're following the pattern that we said that we would. One balance sheet account, one expense account. Okay. All right, one more time. Back up here, billed customers for earned revenue. No cash received yet. No cash received yet. Okay, so those first two, there's no cash involved. Okay, we still want to recognize an expense even if we haven't paid for it yet. And we want to recognize revenue even if we haven't received the cash yet. Okay, so this is what they call accrual accounting. No, it's not cruel as in be mean. It's accrual accounting, right? And it focuses on the fact that we record revenue, we record expenses regardless of cash, okay? Regardless of cash, okay? Here's the other two. All right, the other two. Now, they didn't put this down. Let me move down here. Okay, let me move down so the folks on Zoom can maybe follow along a little bit. So once again, if we're going to record, we're gonna accrue revenue, we're gonna make accounts receivable go up with a debit, and we'll make the revenue account go up with a credit. If we're going to accrue an expense, we're going to put that amount in an expense account, and then we're going to put it in a payable. Okay, we're going to put it in a payable until we write checks, until we cut checks, because we don't cut checks every day, probably not. So,
It's page 126 in the text.
okay, yeah, page 126 in the textbook, if you're following along. And I did hand out some sheets here in class, and so you'll just have to use it comes from the ebook. Okay, it comes from the ebook. So pages 126 through 129, I think. 130, sorry, actually shows you the entries. Then it shows, so I'll explain that here in just a minute. Let me finish this part. Okay, so now we're going to talk about these two. Okay, these two are considered deferrals. Okay, deferrals. Now, they didn't use that word much in the book. And sometimes the word deferral seems to be confusing, but I'm going to put it down anyway, just to make sure in case you run across it, that you're ready. Okay, so this is going to be a deferral or deferred. So the first one is deferred. Okay, unearned revenue. Okay, so let's put unearned revenue. So this is deferred revenue. So we're gonna wait to recognize the revenue, okay, as opposed to going ahead and putting it in, okay? Unearned revenue is a liability, okay? I argued with the WSU teacher why a liability would include the name revenue. Why? Because that's very confusing. You think that's a revenue account, and he had no answer. It was fine. But if he would have just said, just ignore this word and pay attention to this word means it's a liability. You haven't earned it, right? You say, like what? Give me an example. So let's say we're a concert event business, right? You know, concerts, you pay for your ticket sometimes a year ahead of time, right? So all this money is coming into a concert business, and the cash has gone up at their business, but they haven't had the concert yet. And maybe the concert is a year away. So they're gonna hold that money. Yes, the cash has come in, that's no problem, that's going to the bank. They can't recognize the revenue of the concert until they have the concert. Okay, so remember, every transaction, there's an obligation from each side to give and get some, right? So if you've paid your money to go to a concert, you've done your side of the transaction already. Then it's the business's turn to do their side of it when they give the concert. Okay, but like I said, if the concert isn't for quite some time, we've got to put that somewhere until the concert can be held. Okay, so we'll do some examples of this. All right, of course. So here's so what this is, cash is received. Yes, this one is cash is received, but not, revenue is not earned yet. It's not earned yet, but revenue is not earned yet. Okay, so the entry is going to be that when we earn it, okay, that we will lower. Okay, so what we're going to do is we're going to lower the unearned revenue. And when that concert happens or the time passes, whatever it takes, then we're going to move it out of the unearned revenue and move it into the revenue account. Okay, so one more time, let's just see what they're saying. They're saying transaction cash has been received for revenue that will be earned in a future period. So the journal entry, when you first get, so cash comes in, right? And we haven't earned it yet, so we got to put it somewhere. We are going to put it in a liability. Unearned revenue is a liability. So we're going to make that liability go up because we owe the earning of whatever it is that customers are sending us cash for. When the concert happens or when time passes or whatever, then we'll move a certain amount out of the liability and into the revenue. Okay? So it can't just sit in that liability forever. You said, well, what if we cancel the concert? Well, then we got to be sending money back, right? Or something, right? We can't just, yeah. Well, and we're not really holding the cash. It's in the bank and we're using it to pay things, but we can't recognize that revenue until we have the event that we say we're going to have. And it comes to pass. And then you're going to find out that some of these, time just has to pass in order for it to be recognized. Okay, so I'll help you understand that in a minute too. So, but, and I get a little worked up and excited about all this stuff because this was really hard for me to understand when I was learning. And I just want to do everything I can to try to help you, see what's going on here. All right. So the next one is called a prepaid expense. So it's known as a deferred expense. Deferred means to put off, right? To wait till later. So we're going to use an asset with the word prepaid in front of it for the most part. Okay, remember I said, if you see that word prepaid, what is it always? It's always an asset. Just like the word unearned. Unearned is always a liability. Always. Okay, you can count on that. So once again, if you see the word expense, make sure you look at the first word. If you see the revenue, make sure you look at the first word. Okay, so you don't miss it. All right, now this one is the cash has been paid for a future expense or a future expense. So some examples would be prepaid. Maybe we paid insurance for a whole year. Okay, maybe we paid insurance policy for a whole year, and maybe every month we want to show a 1/12 of that being used, right? Or something like that. Maybe we paid, maybe if we have a landlord, maybe we have paid rent ahead of time. Maybe we've paid 3 months worth of rent ahead of time, and we would make the cash go down. We would put that in prepaid rent. And then as time passed, we would move it out of the asset into an expense. So the adjustment for number 4 is to make that asset go down. Okay, so let me make sure that I'm following this. Okay, so the adjusting entry, and by the way, here's the balance sheet account, and here's the income statement account. Okay, IS is income statement, balance sheet is BS. That's funny. Okay, so now we have the entry. The asset will actually go down, and then we're going to make an expense go up. That's the adjustment for this particular kind of adjusting entry. Okay, let's see if I'm following this pattern like I said it would be. Every entry has one balance sheet account, one income statement account. Look what's happening. Revenue is either going up or going up. Expenses are either going up or going up, right? Yeah. This asset is either going up or this asset is going down. Liability is either going up or this liability is going down. Just depends on what's going on. The last one has to do with depreciation, okay? We're not going to get into a lot of it because we have a chapter in our future that we will look at this depreciation more closely. But in the world of accounting, depreciation just means that you're expensing a fixed asset. A fixed asset, okay? So something that we bought that we plan to use beyond a year. So for example, they show equipment and buildings, right? Equipment and buildings. Fixed assets depreciate. Fixed assets are expensed as they are used or consumed in the business operations. Okay, so this one is very similar to this one. Okay, and that's why they make it separate, but make it last. So this one kind of goes with this one. So what's involved with this is if you have a fixed asset on your books, okay, you have to have a fixed asset in order to depreciate anything. Okay, it's got to be something that you bought, that you plan to use in your business, that's gonna last probably longer than a year, okay? So, like they're giving an example of equipment here. So let's say we bought a piece of equipment. Okay, I'm just making up something here. Let's say that this piece of equipment cost us 20 grand. Okay, we're gonna use it. You're going to be introduced to your very first contra asset. Contra asset. This account only exists to go hand in hand with this one. Okay? Kind of like peanut butter and jelly. That's why I put the parentheses around the two accounts. Nowhere does this one go without this one. Okay? So this one is called accumulated, and I'm going to abbreviate, accumulated depreciation for this piece of equipment. Okay, so what we're going to do, instead of debiting this piece of equipment as we use it, we're going to use this account that has an odd credit balance. Okay, it's gonna have a credit balance, and as we expense this asset, we're gonna put the credit in this account. So we can keep this asset intact, you know, what we bought it for, because we may end up selling it someday. Okay, and we wanna make sure that we haven't reduced the equipment account. We're gonna use a contra asset called accumulated depreciation. So the adjusting entry that will happen is we're going to have an account called depreciation expense. Okay, depreciation expense, and blue is about to go. So depreciation expense. So this is a new account. Depreciation expense. Okay, and depreciation expense will have a debit normal balance, right? Debit normal balance, credit normal balance for this contra asset. And remember, this asset has our usual debit normal balance. So they're going to have to tell us in this chapter how much the adjusting entry will be for depreciation. So whatever they tell us, we'll put it down. And this is how the entry will go. It'll go make this one actually go up, but it goes against this one. Okay? And then when we credit this, we debit depreciation expense. So here is your income statement account. This is your balance sheet account. And technically, this is going to make this asset go down, but in a separate account. Okay? So, all right. Real quick, I just want to show you the rest of this packet. I'm going to let you look at it. I'm not going to go through it step by step, just for you to have an example. So, if you look through the chapter, these are the adjusting entries they end up doing. Notice all adjusting entries get the date of the last day of the period. So if we're looking at the last day of a calendar year, then all adjusting entries get December 31st. If we're looking at September's month end, okay, it depends on what a business does. Some businesses don't do a month worth at a time. They wait and do just a year. Some businesses do it a week at a time. Okay, so that's really wanting information. So here are the adjusting entries that were made in the book. And they walk through each of those, including depreciation down here. Okay, so if you want me to, there's accounts receivable going up. There's revenue going up. So there's that accrued revenue. So you could put the number 1 beside that if you want to. Wages expense, right? That's accruing. That's an accrued expense because we're going to put it in the expense account, but then pay it later. There's the unearned rent. The unearned rent. That is reducing the unearned rent and then recording the rent revenue. So what happened there was we have a tenant who sent us 3 months worth of rent early. Cash came in, we couldn't record the revenue for it because time hadn't passed yet. You know, so we got to put it in that unearned rent account, which is a liability. And then after each month, we'll show. So obviously rent is $120 a month. So each month we'll move it out of the liability into the revenue. Number 3 is a prepaid expense. Supplies is a prepaid expense. You don't always see the word prepaid in front of the word supplies. I like to put it there so there's no confusion. The other one is another, so the insurance expense issue, that's a prepaid expense adjustment. And then finally, there's the depreciation expense adjustment. Okay? Now, what this does is this takes all of these and posts them in the ledger. Here sits your ledger. Cash is never adjusted. Cash is not part of the adjusting process. Okay, so you'll never make an adjusting entry that includes cash. Okay, everybody got that? You'll never see an adjusting entry in cash. You say, well, what if we've made a mistake? That is a correcting entry, not an adjusting. Okay, but the adjusting entries, how do you know when they hit the ledger? They've got them highlighted, right? They've got them highlighted. So each half of each of these entries, and I'm sorry for those that I can't see this very well. This is on page 127 in your book, if you want to look at it that way. So let's just flip the page, right? Let's just flip the page. So accounts receivable received an adjustment. Supplies received an adjustment. Those are both assets. Prepaid insurance received an adjustment. Unearned rent received an adjustment. Accumulated depreciation received an adjustment. Fees earned received an adjustment. Wages payable, rent revenue, wages expense, flip page. Supplies expense, insurance expense, depreciation expense. There's where we posted all of those amounts. How many different accounts is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, I think. 11, 12. That's 12 different accounts that if we would not have made these adjusting entries, would not have reflected the amount we really wanted in there. Okay, so that's the idea. So then the last step, when you post everything to their ledgers, right? The last step is to make an adjusted trial balance. And there it says, an adjusted trial balance, right? Looks an awful lot like the unadjusted one. You gotta look at the title. And one more time for the record, all debits must equal all credits in every trial balance without fail. Okay, everybody okay with that? And once this is finished, then we're ready to move in to creating financial statements, which is chapter 4. Okay, so having said that, let's dive in. Sound all right? Say yes, please, because none of this helps me. Well, I want to at least give you some kind of reference to work with, because I cannot tell you, I think I would have given a lot of money to have this kind of a summary back when I was doing this, because I don't think it existed. Okay, so it does help a lot. All right, let's jump in. Let's see if we can understand some of this now. Okay, so let me come down here and see if I've got, I think I've got 319. 319 is our very first problem. Okay, very first problem. So if you're going to follow along with how to solve these, of course, you'll want to draw some T accounts. Okay, so here we go. Here we go. Move it over just a little bit. All right, so we can make sure we have enough room. Okay, the balance in the equipment account, right? So I'm going to make, this was from the last time I did this, so I've got to change things because they changed the problem that I work with. So the beginning, it says the balance in the equipment account is $455,000. Okay, whatever your problem says is what you need to put down in a T account. All right, so I'll draw it here too, just to try to be consistent. So here is the equipment account. It has a beginning balance. Here's mine. You put yours down. Okay. Yeah. The balance in the accumulated depreciation equipment account is, so you're going to draw these two that go together all the time. Accumulated, you can abbreviate. You just got to know what that abbreviation means. Accumulated depreciation for the equipment. And it's going to have a normal balance on the credit side. Okay. So the balance in here is $241,200. Okay, I'm going to make this bigger, hopefully, so you can see it. I'll pull it over here. And I'm going to change the amount I've got in my, so here we go. Contra asset, the contra asset to this piece of equipment, right, has $241,200. Okay, so each of these start with a beginning balance. It says, what is the book value of the equipment? So here's how you find book value. Okay, so if you want to write this down, book value of this asset is the asset value minus the accumulated depreciation. Remember, what does depreciation mean? Expense. So we have expensed quite a bit of this, right? 455,000, we've expensed up to now, 241,200. Okay? So the book value is the difference. It's whatever's sitting here minus the balance in here. So the book value for me, right? And I think I've got a little formula here. Yep, I've got a formula that takes the balance here and subtracts it. And my book value is what's left over to expense, what's left over to depreciate, right? I've got 213,800. Okay, so this is the answer, 213,800. This comes in over here, this comes in here. So that's how much we have yet to depreciate. If this depreciates fully, when it's all said and done, guess how much is going to be in this account? The whole amount, once it's completely depreciated, right? And so I know this isn't what this is asking, but whenever this happens, guess how much the book value will be? Book value will be what? 0. You say, what? Yeah, because whatever this piece of equipment is and however we're using it in our business, we have expensed the whole thing. We've used it on our income statement. Okay, once again, depreciation just means expense. In a depreciation in the real world can mean that something has less value than it did before. That's not what it means in accounting. Accounting just means it's the specific word used when you're expensing a fixed asset. That's it, okay? So once again, we wouldn't buy a piece of equipment that we wouldn't use in our business. That would be silly, right? I mean, if we were a farmer, we probably wouldn't go out and buy a great big pizza oven. I mean, that'd be silly, right? So whatever we're buying or investing in our business, if it's for operations, then it's going to get expensed. Now, I don't want to get off into a rabbit hole here, but yes, you can buy things that you want to invest in that you don't know for sure what you're going to do with it later. Okay, so please understand, we haven't gotten into any of that kind of stuff yet. But I just want you to understand how these accounts work. They go hand in hand. I call them peanut butter and jelly. Okay, peanut butter and jelly. Contra asset always goes with the asset that it is countering. Okay, so let's put it in. Does the balance in the accumulated account mean that the equipment's loss of value is 241,200? No. No, it's not loss of value. We're using it. Okay, we're using it. So because depreciation is an allocation of the blank, so let's see what we have here. The cost is what we're allocating. Allocate means to spread out, right? Spread out. So maybe this piece of equipment's supposed to last us 10 years. Maybe it's supposed to last us 3 years. I don't know. It just depends on how we use it, how quickly we use it. There's different depreciation methods. Don't worry about those right now. We'll get there. Okay. They're going to have to give you the amount that is going to be depreciated as the adjusting entry. So you don't have to find it. Okay. So, but we just wanted to review a little bit about these accounts that go with fixed assets. All right. So I think we got that one. Let me check my work and make sure. Okay. All right. Let's go to the next one. Okay. Let me come back to that one. Okay. Okay, I'm going to help you do some of the ones you need to do at home because I really need to show you how they work. So if everybody will go down to number 7, I'm going to help you. Okay, I'm going to help you and maybe we'll get it all knocked out. Okay, So the first one is an adjusting entry for something called accrued salaries, okay? Accrued salaries, so accrued, it's gonna be right here. So it's gonna look something like this. All right, so how many of you work and get paid for that work on a later date? I work for a whole month and then get paid. Most of us would have a lot of troubles if we got paid every day at the end of every day. That would be a nightmare. You go to the bank all the time, right? Or depositing checks or whatever. So the business world has figured out that we get employees to work for us in a pay period, right? A pay period, and then we'll pay them for that period on payday. Well, some pay periods have one part of a month and another part of a month. Well, in accounting, we don't want that. We want all of September's wage expense in September and October's in October's. So here's an example of how we're gonna do this, all right? So, let me erase. Okay, Classic City Realty Company pays weekly salaries of $31,800 on Monday. So if you took all their employees together, they pay them weekly. Hello. All right, so we have weekly payroll. Okay, that equals $31,800. Write down the amount that yours is shown. Okay, please. And this is for a 6-day work week that ends on the prior Saturday. Well, I don't know about you guys, but I gotta see pictures, right? So let's see, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. That's 6 days, right? 6 days that we work. And then we're off on Sunday. And we get paid for those 6 days on the following Monday. Does that help? To see it a little bit, right? So let's go ahead and figure out how much each day's pay approximately is. So if you take the amount you've been given, 31,800, I'm gonna divide by 6 to find out how much it is per day. Okay, per day. And let me see, I don't even know if I have this one on here, but I'm working it for you anyway. Yeah, I don't have it on here. That's okay. I'm just helping you work this because I think you need to go through some of these before you'll start to get the feel of it. Okay, so hang in there. All right. So let me do the math on mine. You do the math on yours. Then we'll go see what else they want. So 31,800 divided by 6. Mine ends up being $5,300 of wages or salaries. And by the way, salaries is a set amount, right? Salaries is a set amount. Wages are weekly amounts. But to me, wages and salaries are kind of all the same. They're all payroll. Okay, so this is per day. Okay, now let's read what it says. It says, journalize the necessary adjusting entry at the end of the accounting period, assuming that the period ends on Wednesday. So here is where the period ends. I don't think so. Okay, it might be. Watch your dates. Watch your dates. And you are on. I just want to make sure you're not in intro exercises, are you? Okay, just want to make sure. So yours says the period ends on Monday? Okay, what does it say? When do you get paid?
Ending on the prior Saturday.
Okay,
That's all the same.
Can I see? I just want to see. Okay, so what you would do is All right, so if the period ends on Monday, you draw the line there. Mine is ending on a Wednesday. Anybody else ending on a different day? Thursday. So just draw your line. Okay, just draw your line. It's all right. This is the period end. What this means is that these 3 days need to be put in. And now are we looking at, I don't know if we're looking at a certain month. Doesn't look like it. These 3 days go to this period. And these 3 days go to the next. All right. So knowing how much the wages are per day, I'm gonna take 3 days worth and do an adjustment. Okay, 3 days worth times my amount that I'm getting per day, right? So put that in. Okay, 3 times 5,300. Whoop. Okay, so yours would only be 1 day's worth.
It'd be the daily.
Yeah, so just that 1 day's worth, that should be your adjustment. If that isn't how it works out, let me know. Okay, so right now, I'm gonna put an entry in to make this adjustment of this. So what I'm gonna put in is, and this is salaries, okay? So this is gonna be a salary expense that we wanna make sure gets put in this month that we're ending, right? So we're going to put this in salary expense, and the offset will go to salary payable. Okay, and this is what you call accruing an expense. We're putting the expense in, but we're not paying it yet. Okay, so the offset, and you'll learn as you go, the adjusting entry, salary expense, the offset will always be like a salary payable. Okay, those will go together all the time. So I'm gonna put in this amount. If somebody doesn't get their amount, please let me know and we'll figure it out together. Okay, so I'm gonna see if I can get mine to work. And then if somebody needs help, we will do it. Okay, so salary expense gets 3 days worth. All right, and whoops, I meant that to be payable. Sorry. Okay, so there's the payable, right? So you have 1 day, so however much your 1 day, so Mindy, you said yours is Thursday, correct?
It's actually on Monday, but mine's worded differently.
Oh, it is. Okay, let me see. So it says, journalize the necessary adjusting period ends on Monday. Okay, so you definitely still need to take 40,800 divided by 6, right? Right. All right, so if Monday is the end, then it's just 1 day's worth. And then the other one you have, if it ends on a Thursday, then that's what, 4 days worth?
Yeah.
You see what I mean? So you just have to see where it's
Worded different.
I know, and I'm sorry they are worded so badly, but in the real world, you don't have any of this instruction. So you have to come up with your own words. I know. So that's okay, that's why we're here. Now I got mine split in half, and then my second choice, or my second option was to end my period on Thursday. All right, so then this next one, this is my first entry here, right? This and this, and I'm gonna put beside this, I don't know if we're at the end of the year or whatever it is, but I'm gonna put a date. And I'm also gonna do this. I'm also gonna put 3 days. Cause that's telling me that's 3 days worth. And that helps me remember why it's that amount, correct? Yep.
So because it's Thursday, instead of the Monday, we'll do it by
4. 1, 2, 3, 4. Yeah, that's right. Okay, so the next one that I would do is the same amount or the same accounts, right? So salary expense and salary payable, but it's gonna be for 4 days, right? So it's just a matter of calculating 4 days times my amount per day. Okay, so I guess I thought we all had the same pay periods, just different amounts. Okay, anybody need help? 4 times my daily amount. 21,200, okay? I'm gonna put 21,200 for my B, so this is A, this is B, okay? And then 21,200. All right, so let's put that in. If I can get my, does anybody need help? Don't be shy. Nobody's gonna laugh. Nobody's gonna say a word. In fact, it'll give us an opportunity to learn again. Okay, so don't be, I wanna try to help you get it. Okay, so this is doing an accrued expense. Accrued expense means that we make the expense go up, right? Both times we made the expense go up with a debit, but we put it in a payable because we weren't ready to pay the cash yet, but we wanted to make sure. So my first one is 3 days on the period, the period end that we're working on. And then my second one was 4 days. Make sure that we're recognizing the expense that's happening in that month, right? Next Tuesday is September 30th, right? So any business that's doing month end for September 30th, if their work week is Monday through Friday, they've got 2 on one pay period and 3 on another. Make sense? So once again, accountants split that up so that expenses are reflecting and revenues are reflecting the period of time that they really represent. Okay? It's called the matching principle. We're going to match expenses with the revenues that they help generate each month or each year. All right? Okay. So we just did one. And once again, this is an adjusting entry. Adjusting entries are happen on the end of the period. All right, this one's a little easier, thankfully. All right, let's talk about supplies. So let's see, supplies. Remember, I said supplies is part of this prepaid type of entry, right? So sometimes you have to have the backstory of the account that you're about to adjust in order to make it make sense, okay? So let's see what they're telling us here. We're going to draw a supplies T account, okay? So what we're going to do is make an adjusting entry for supplies, okay? Draw you a T account. And we'll put supplies here. That's an asset. It has a debit normal balance. Okay, so let's see what they say. The balance in the supplies account before the adjustment, okay, before the adjustment is 1742. Okay, 82, sorry. Mine is 1782. Okay, write it down. Okay, before the adjustment. Okay, it says journalize the adjusting entry required if the amount of supplies on hand at the end of the year is $838. So here is your ending balance, $838. Okay. What do you think goes with supplies? Is there another account that has the word supplies in it? That's right. So you can start thinking like that. Okay, nothing wrong with that. So we're going to put supplies expense here, but we're going to have to solve for the amount that this account went down. Because if it had 1782 and now it only has $838, we need to know the difference because that's the amount of supplies that went down. When this account goes down, the offsetting debit goes in the expense account, okay? So let's do the math here. Okay, 1782 minus 838. Okay, so 944 is what I got. I'm gonna double check. These two numbers should add up to the balance before we made the adjustment. Okay, so nothing wrong with double checking. Yep. When you credit this, you debit this. Okay, but then when you put the entry in, you want to put the debit in first and then the credit. Okay, so that's what we're doing. So what are we debiting? Supplies expense, right? Supplies expense. Okay, supplies expense gets the debit for the difference because they want to know how much supplies we used. Okay, and then the prepaid supplies asset account is going to go down. Okay, and once again, this is going to be a year-end entry that is made. Okay, everybody good with that? Okay, let's go to this one. Okay, let's go to this one. Okay. Okay. Sometimes you have to make more than one adjustment, and sometimes more than one adjustment. Right, so here it says, adjusting entry for unearned, and accrued fees. So these two entries both affect revenue, okay? So let's just start with some T accounts here. We're gonna draw a T. Okay, draw a T. Let's put the first one in. First one is unearned fees. What does unearned mean? Remember? Unearned fees is a what? Liability. It's that word there that's most important. A liability has a credit balance, right? So before the adjustment, put in the amount of that account before the adjustment. Okay, so then it says of those unearned fees, 62,570 have been earned. So if something's been earned, we can move it out of this liability and into fees earned. Okay, fees earned is your true revenue account. Fees earned is your revenue account. We want to record this as revenue as soon as we can, but we got to earn it first. Now, I don't know what we're doing to earn it. That's okay. But they say that whatever time period we're looking at, we have just earned 62,570. So if we debit this, what do you think we're going to do? I'm just going to leave it down there. Okay. 62,570. So here is your adjusting entry right here to make this liability go down and to record the revenue as it should be. Okay, so let's go ahead and put this entry in. Okay, so this is going to be that unearned fees are going to go down because we've earned it. So we still have some unearned fees that we haven't earned yet, but we get to record it in the revenue account. Remember, revenue is going to go on the income statement, and we want it to reflect what really happened. Okay, here's the second one now. In addition, fees of $12,110 have been earned, but not yet billed. Okay, so we're looking at accounts receivable. Okay, remember, if you're billing a client or a customer, then we must have found some jobs that we finished that needed to be billed. And then the amount for that, for me, is $12,110. When we put it in this accounts receivable, this is accrued revenue. Okay, so whatever the end date is, and we're just going to use this account. This is the account we need. So we're gonna make it go up with this adjustment, right? So just these two adjusting entries, one was to say we earned the revenue finally, and the other one was to send bills to customers to let them know that we're done and they need to send in their payment, right? So once again, we get to recognize all of that revenue, and doesn't necessarily mean that cash came in. We're waiting for this cash to come in. We've already received this cash, but we put this in this liability, right? So when we received the cash for these unearned fees, we had to put this somewhere so we could earn it. So these are two different entries that affect fees earned. Yep, so let's go ahead and put it in. So accounts receivable is gonna get the amount that we billed our customers. So 12,110. And revenue, fees earned. Don't pick fees expense. That's just there to mess with your head. All right, so there are two entries right there that need to be done. You say, what's this one? This is that unearned fees. That's number 3. This is called deferred revenue. This one's called accrued revenue. Okay. So I just helped you do these 3. Let's keep going. Now let's go to this one. Okay. So the only one I'm hopefully only going to leave you with is this blank sheet here. This one right here, number 6, should be the only one you'll have to do if we can get through them all.
Or about number 3 or 2.
We're going to number 2. Sorry if I said the wrong thing. Okay, so let's try to, all right, so this next one is, well, what if you have errors on the financial statement? What is that going to do to various accounts? So all I can do is let's put it in the T accounts so we can see what's happening. Okay, so get you 2 new sets, 2 new T accounts, and we'll see what we got. Okay, and I think I have this now on my spreadsheet. Okay, so I'm ready to start doing some of the problems now. So this is 323. Okay, this is 323.
Can we take just submit it?
Sure.
We like take a 5 or 10 minute break real fast.
Okay, you want to take a break?
My brain hurts.
Your brain hurts? I know. Okay. How about 5 minutes? Okay, 5 minutes, take 5-minute break. Okay. Very good. So, take a break, go get something to drink. Mr. Gates, I have a question for you before you leave. Are you just kind of teaching yourself, or how's it going? 'Cause-
Right now,
Well, I'm just trying to see what's going on here.
for this stuff,
Well, for the class, I mean, it's okay. If you're teaching yourself, I have no complaints. It's up to you what you want to do. So, okay, we're taking a 5-minute break. Okay, be back in here by 5:30. Okay. So, do you happen to know if you're in my QuickBooks account as well?
Yeah, I am. I was wondering what's going on.
Well, I've been trying to send you something in an email and I haven't gotten any response. Well, I need a personal email account to send you the invitation for QuickBooks because apparently you haven't seen it on your Butler email. Okay. Okay, so because we're about to start, we've had some issues with emails not working in Butler, okay, so I did send everything out to Butler emails, but unfortunately, sometimes Butler emails have too much security around. Okay, you're not getting what you need, so I've asked for a personal email that I can send the invitation to, and our first due date is gonna be next Tuesday. Because, like I said, we've had quite a few complications with those emails, so
Okay.
I appreciate that. I thought that was you, but I just haven't.
Personally, sent it on the box of campus.
Okay, I will look for that, and so you'll wanna look for the invitation to a QuickBooks account. I'll have that done by tomorrow,
Okay,
okay? And so, and I'll have some videos to start with to walk you through a lot of the stuff.
yes, it's good.
Okay, thank you.
Yep.
Mhm.
Thank you for letting me know.
Yeah. I guess I should, because I'm recording. I forgot I'm recording. That's why I didn't want to stop. I knew there was something that I had forgotten, but that's okay. So that those of you out on Zoom, sorry, we're just taking a break. And, but we're probably not going to have any other breaks. So, because we've got to try to get through this. So I am going to pause recording. All right, so we're going to resume record. And now I'll resume the share. Okay, so I'm sharing the screen again. Sorry about that, folks, on Zoom. All right, thank you, thank you. So once again, the first thing that we're gonna do is, this is an omission, okay? So on the screen, you see right here, 2 T accounts. Those of you who are on Zoom, we've got unearned fees, and we've got earned fees. One is a liability, one is a revenue. The reason I have these in red is I put them here just so you could see what it would have done if we would have put it in here, but we didn't. Okay, we didn't put this in here. So we did not reduce, and I'll put this here, did not reduce liability. Okay, did not reduce liability. So this liability has too much in it. It's overstated. And how you express that is with OS, overstated. Okay. Same with the revenue. We did not make this revenue increase, right? So we did not increase the revenue. So this revenue has too little in it. Too little is stated by the words understated. And that is US. Okay, so if we go over here, was revenue affected by the very first omission? The answer is yes, it was. What happened? It's understated by how much? However much the omission was, is however much the revenue is understated. So put that in, please. Okay, it says enter all amounts as positive, enter 0 in those spaces where there is no overstatement or no understatement. So let's put a 0 here. We're gonna have zeros for expenses because that first. Are either one of these an expense account? No, they are not. So expenses are not affected by the first one, but. Okay, come back to income here in a minute. Assets are not part of this, but liabilities are. Liabilities are overstated, okay, by how much? The amount of the omission, yep. Okay, so now we're gonna have to think of it, if your brain hurts before, I hope you got Advil. Okay, because I'll do my best to try to get you to think. Some of this is just gonna have to be memorization. Okay? It's the way it is. So, since this is understated, remember, net income. What makes net income? Net income is revenues minus expenses. Right? And since this adjustment would have made revenue go up, right? But it didn't, it's understated. If this is understated, then net income follows the same path. If this is understated, then so will net income. It won't have as much in it as it should. All right, so put understated for net income. By how much? The omission, the amount of the adjustment that we did not do, okay? And this income actually gets put in retained earnings, okay? Retained earnings, and retained earnings is a equity account, okay? So if net income is understated, then so will retained earnings. Retained earnings will be understated if net income is. So you can, whatever direction revenue is going, up or down, if that's what is going on, that is what is happening to net income, and that is also what is happening to retained earnings, okay? So stockholders' equity, retained earnings is part of that. It's understated, okay, by the same amount. Now let's just check it and make sure my mind is working okay. All right. So that first one, whatever the omission is, should be your revenue being understated. Should be your net income being understated. Should be your liabilities having too much in them. And then finally, because net income goes to retained earnings, which is part of equity, then that is understated, okay? So what we have to do is go to the stockholders, and this is the good news. Here's the good news. This omission, they don't mind. Why? Because you're adding, if we go back and fix it, right? Then guess what happens to revenue? Guess what happens to net income? Guess what happens to the equity? Up. So that's what I call a good mistake. Yeah, it's good news. But let's now go through, well, what if we skip an expense? This is the one that's not so good. All right. So draw two T accounts, please. One is going to be wages expense. One's going to be wages payable, because it says up here, where am I at? This one is accrued wages. Accrued wages meant that we forgot or omitted this amount. $6,990 should have went in this expense account. It also should have went in this liability, okay? So now let's do the under and over analysis, right? So one more time, we didn't do it. So this expense account doesn't have enough in it. If it's not enough, it is what? Understated. Okay, say it out loud. If we forgot to make this liability go up, this liability is understated. This is gonna be on the balance sheet. This is gonna be on the income statement, but be careful. We're gonna go back to this. Okay, so I'm gonna draw it again. Revenues minus expenses equals net income. If you forgot to put an expense in here, right? If this is understated, guess what this is? Overstated. Very good. Very good. It's clicking, right? If you have overstated your net income, this is the bad error. This is where we got to go to the stockholders, right? So what this is saying is we got too much in net income because we forgot to subtract this as an expense because we never did put it in. Okay. So what's going to happen here is if expenses are understated, that makes net income overstated. So guess what that does to come down to retained earnings? Retained earnings then is overstated. So we have bad news to share with our shareholder. Well, we thought we were adding to it, but we got to take back out. Okay, because we missed it, right? So let's walk this through. The second one did not affect revenue at all. Okay, it didn't have anything to do with revenue. It had to do with an expense and a liability. Okay, so expenses were understated because we forgot to put one in. So put the amount in that we missed. Put a 0 on the overstated side. Now, when you understate expenses, your net income becomes overstated. I had a hard time with that. Okay. And then this did not affect assets. It affected a liability. So 0 for assets. By the way, their end date is July 31st. So they have a fiscal year. So if they end on July 31st, their beginning of the year is August 1st. Yeah. Liabilities, right? Liabilities, we forgot to add an amount to the liability. So because we forgot, it is also understated. Okay, so it's understated by 6990. And then, unfortunately, whatever direction the net income is going, that's what's happening with the stockholders' equity too. Okay, because that's where the net income goes. And so look, one little omission, one little omission. It wasn't on purpose. It wasn't a mistake. The mistake was we just forgot to do the entry. Okay. So it needs to make sure to be on the month-end list or the year-end list and make sure somebody checks it, that it's done, right? So we really, just one little omission messed up our income statement. It messed up our balance sheet and it messed up equity. See what I'm saying? So you're like, oh my gosh, every little thing. And like I said, this isn't even an error as in an amount. It's just one we forgot to do. Everybody get that? Did it help to see it? I have to see it. I have to see it. I have to draw the account that it's affecting, put in the amount and cross it out. What would have happened if I didn't put that in there? So, okay, let's move on. Okay, I think this is probably one of the hardest ones. I may leave this one for you guys to do, just so that I can, we've got about an hour left. So let me show you what this one's doing. Okay, here's what we're doing. We're looking at, hey, finally, they're using some small numbers. We aren't using numbers in the millions, for heaven's sake. Now let's just go ahead and do it together. So here's what we've got. Cash. Is cash ever adjusted? No, never. Accounts receivable. Did it get adjusted? It went from an unadjusted amount to a new adjusted amount. That's how you know that account got adjusted. So this is looking at both trial balances, right? This is the unadjusted one, and this is the new adjusted one. So cash wasn't affected by adjustments, but accounts receivable was. What happened to accounts receivable? Accounts receivable actually went up, right? And I may have to replace that amount. Okay, so the difference between 45 and 38, okay, is 7. Yep, so I need to show that accounts receivable went up 7 and fees earned went up 7. So let's go down. So however much the difference is between your accounts receivable, so we said 7, yep. So if you go down to revenue, which is fees earned, okay, there may be, okay, so between 74 and 81 is exactly 7. Does everybody see that? So yes, this is the entry that was made. So we're kind of backing into our entry by looking at the trial balances to see if we can figure out what adjusting entries were made on the last day of October. Okay, so let's put this in. Accounts receivable went up 7 because we compared it to unadjusted to adjusted. And we looked at fees earned, and that was also 7. So let's go ahead and put that entry in. Okay, so that's the accrued revenue. We found a job that we forgot to bill a customer for, and we did. Okay, so go ahead and check your work. What's the difference between accounts receivable unadjusted, accounts receivable adjusted? Okay, we're just going to go down the list. Now we're looking at supplies, right? We're looking at supplies. I've got an amount between 12 and 11. That's just one. You need to see what your amount is between the two. So we had 12 and now we're down to 11. And what always goes with supplies? Supplies, expense. Very good. Now it had nothing in it when we did the unadjusted, but now it has 1. So that's going to match. Okay. So here's what we're doing. Over here in my little spreadsheet, we're going to make a debit. We're going to make a credit to prepaid supplies or supplies, and we're going to make a debit to the expense account. Okay. So let me fix this. All right. So the 1 is going to be debited to supplies expense, and the 1 is going to be credited to supplies. So let's put supplies expense 1 for me, and supplies went down the amount because it's an asset. Okay, if you want to check your work, that's fine. Okay, we're going to keep going. Is there a difference between prepaid insurance unadjusted to adjusted? You should see a difference. I see a difference of 11. All right, so now go down to insurance expense. Mine goes from 0 to 11. So there you have it. So prepaid insurance is going to go down 11 with a credit, and we're going to debit insurance expense for the same amount. Okay. So let's put an entry of insurance expense in of 11, and we're reducing that asset for the amount that we expensed, and check it. Okay, and check it. Okay, we're still walking down the assets here. How about land? Did land change? So it's not part of the adjusting process. How about the fixed asset equipment? Did it change? But its partner accumulated depreciation went from 8 to 11. So we added 3 to accumulated depreciation. And when we do that, we can go down and look at depreciation expense. And I had 0 and now I have 3. So we're going to make an entry we're going to make an entry of a credit to the accumulated depreciation of 3 and a debit to the depreciation expense account. Okay, so let me get rid of those decimals there. I don't mean to have them there. So let's put a depreciation expense of however much yours is, and then make sure it gets credited to accumulated depreciation. Okay, last one to evaluate. So we were marching down the list here. I think we stopped at accumulated. So accounts payable, did it change? Nope. How about wages payable? Yep, it had 0 and now I have 1. If you go down to wages expense, mine went from a 24 to a 25. So we want wages expense going up 1. Okay, we want the liability going up 1. And this is our last adjusting entry. Okay, we want wages expense for the difference that your trial balances show. And then we want wages payable. Okay, so we went backwards, right? We went backwards to see if we could figure out why those accounts changed, right? Because when we're finished, you're going to see an adjusted amount when you're finished with adjustments. This is before the adjustments. This is after. Just scroll down a minute. Okay, let's scroll down. Look, here's the difference, right? If we would not have made these adjustments, then we would not have additional information about the company for October. Okay, so that's that one. Now we're ready to go to one of our big ones. Okay, do you need another break? Want another break? Are you okay? Okay. If you need a break, just take one. Okay, I don't care. If you leave, though, please let me know if you leave. Let's go to the blank sheet. I have given you a set of, I've given you this problem, okay, right here on a piece of paper. So pull that out, and we're going to walk through some adjusting entries. We're going to decide what they're going to be, and then we're going to go put them in the general journal. And the good news is we don't have to post them to the ledger. All right, so here we go. What's our date? July 31st. So I'm going to fix mine. Last time I did this, it was October. Okay, so I'm going to put, I really try to make sure you think about what's the time that something is happening, because dates are very important. So I want to put July. Month of July. July has 31 days. Yep. How many days does September have? 30. It's coming up. So month of July. All right. So the first one, I've got 2 T accounts. So if you want to draw them, that would be good. I'm going to use my Excel spreadsheet here. All right. So I've got a prepaid expense account because it says the supplies account balance on July 31st is $4,115. So if you'll draw a T account, 2 of them, if you will, put prepaid supplies and supplies expense on each of those T accounts. Now I'm going to put a beginning balance in my asset account. Right here is the amount you'll want to put in for the beginning balance. Here we go. So I've got $4,115 as my beginning balance. Okay. They say supplies on hand at the end of July. That's going to be your ending balance. So you're going to know these 2 things. I've got $990. Okay. I have to figure out here, right? And I've done this already. I've got a formula. My formula is you take the beginning right? Take the beginning minus the ending. And you find out how much went out of there. Okay, so my example, and let me make it bigger for you to see it up here on my spreadsheet. I think. Okay, so here it is. Here it is. Here's my beginning balance. Here's my ending balance. And here's the amount of the adjustment. So we're going to make supplies go down by that much. And when we credit it, we need to debit what? We need to debit supplies expense for that same amount. Now we're going to put it in the journal, the general journal. The general journal, we're going to put this in as July 31st. Okay, so I am going to have to move a few things here and make it a little smaller. Sorry. All right, so let's go down. Let's put July 31st. That's going to be our date. July 31st. That's going to be all of our dates for this one. The first one we're going to do, we're going to debit the supplies expense account for however much we figured out it needs to be adjusted, right? It needs to be adjusted. I'm going to get rid of the decimals. Mine is 31.25. Okay, moving it over. And I think I'm going to have to make this smaller. It's just the way it is. We'll work it through. We'll work it through. You can see it better on a screen. I know when you're looking at the screen. All right, so one more time. And I may have to make this smaller so you can see my journal. Yeah, don't worry about these three columns over here. This is just going to show you what the effect is going to be. So the good news is my debit is 31.25 to supplies expense. Let's put it in. Supplies expense. Okay, it's a debit. And there is no way to tell it what the account number is. So we don't have to do anything with that. Now, what are we crediting? We're crediting the supplies asset account, 31.25. So we have put this first entry in, but we analyzed it over here. That analysis is going to help me later. If I made a mistake, right? If I made a mistake, I can go back and double check what I did. Okay. Now we're ready for the next one. So let's read it straight from the sheet. Okay, the next one says, wait, you guys might have a different one. Do you guys have a different one? This is where, nope, it doesn't say algorithm. So we're doing the same one. All right, that's good news. Okay, we're doing the same numbers for both 4 and 5. So we are concentrating on the same numbers. Hallelujah. You'll get a separate set of numbers for your opportunity to do 3-5A. All right, I forgot what's going on here. All right, let's put the new date. Our next entry is going to be July 31st. Okay, let's see what's going on here. It says that unearned rent balance on July 31st. Okay, so I've got to put a new beginning balance in. Unearned rent is going to be a liability, so you're going to put it in as a credit balance. So the credit balance is $14,380. So sometime before the end of the month of July, we received some cash that we had to wait to earn the rent. Okay, this represents 4 months worth of rent. Okay, so down here, you can't probably see it very well. You'll want to take that amount of $14,380 and divide it by 4 months. Divide it by 4. Okay, so I'm going to do that in my Excel spreadsheet here. 14,380 divided by 4 months. That means that each month is going to be $3,595. This is going to be the new adjustment. We need to show that we have earned this rent revenue. It's 1 month worth. So let me go back and fix this, okay? I want this to show the solution. So it's 14,380 divided by 4 months. Let me take out the equal sign. So it leaves that little, it didn't leave it there. Okay, I gotta change it to a text. Hang on. It thinks it's a, all right, so now that I've changed it to text, let me try this one more time. 14,380 divided by 4. I just want that there so you can see that that is the amount. So here comes one amount of 1 month's worth. So 35.95. We're gonna show that we earned it. How did we do it? We didn't do anything. Time just passed. Okay, so when we received that 14,380, cash went up. That was back whenever we received it before the month of July, and now 1 month has passed. So we now get to reduce that liability and record the revenue. So we're going to get unearned rent for a debit of 35.95 and rent revenue for a credit of 35.95. Okay. So we have analyzed it right here with these two T accounts. So here we go. Unearned revenue. Unearned rent, excuse me, unearned rent. I gotta make sure I'm using the right, and it shows your account, chart of accounts right here. Okay, so if you have any question of what an account is called, you can always scroll up and get the name of it up here. So here we go. Our second adjusting entry is recognizing or lowering the liability of unearned rent and recognizing 1 month's worth. So rent revenue gets the credit for 35.95. Okay, so that is this one. Let's put July 31st again. Okay, so now the next one says wages accrued but not paid on July 31st are 51.20. So this one's a little easier. This one you didn't have to figure out anything. Okay, you didn't have to figure out anything. So to accrue an expense, we simply put that expense in that expense account. So it looks like it's 51.20. Right? So we're accruing it. We're not paying it yet. So we're going to make the liability, wages payable, go up for the same amount. So what is it we're doing? We're debiting wages expense for 51.20. We're crediting wages payable, a liability for 51.20. Okay, so here we go. Wages expense of 51.20. Okay, wages payable gets the offsetting credit of 51.20. Okay, let's put July 31st again. July 31st. Okay, the next one says fees earned, but we have some unbilled but we're unbilled at July 31st. So this means we need to send some bills to customers. How much? We are going to send out bills of, so let's put accounts receivable and fees earned are our two accounts that we're going to analyze. So 31,450. 31,450. So they just told us what it is. We didn't have to figure it out. So that's going to be an adjusting entry. So the entry is going to be accounts receivable of 31,450 and fees earned, there's your revenue going up. Fees earned 31,450. And we're ready to put our last adjusting entry in, July 31st. Okay, let's analyze it. Okay, let's analyze it. It's saying that depreciation of office equipment is $28.50. So now I did not draw the equipment account. I did not. But this accumulated depreciation is sitting here and equipment is sitting here next to it. We just can't see it. But let's put the amount. So the depreciation expense, I'm going to debit it for $28.50, and the credit goes in the accumulated depreciation for that equipment. So I'm probably going to use the chart of accounts here, right? I'm going to use the chart of accounts so I don't have to spell all that out. So here I go. So we want depreciation expense to copy. And we want accumulated depreciation, okay? Accumulated depreciation is over here under assets because there's that asset that it goes hand in hand with. If you'll just copy that and bring it in, that gets the credit of every adjustment for depreciation. It's going to look like this, right? And once again, they said depreciation was $28.50 and $28.50. Okay. So we analyzed all of this using T accounts. The first two, we had to find the adjustment amount, but the last three, they just told us what it was. Okay. So that was nice of them on some of them. Okay, so let's go ahead and check our work. If you put everything in correctly in the journal, you should get, I think, 25 out of 126 out of 126. I don't know where they get that, but that's to let you know that it's done completely, right? Or 25 out of 25, that's better. Now, the last question says, and I kind of already have talked to you about this, but what's the difference between an adjusting entry and one that's actually meant to correct something, right? So let's see if we can find it. Adjusting entries are planned, part of the accounting process, right? Yep. Correcting entries are not planned. They just need to be done when we find an error. So my first one is the right one. I don't know if yours is in this order or not. It is. Okay. So we got lucky on the first one. Everybody good with that? Adjusting entries are what? Planned, expected, part of the accounting process. But a correcting entry is we miskeyed, we misread, we didn't know there was another part of something to an entry or whatever. And we need to make a correction, right? So adjustments are not corrections. Adjustments are planned and part of the accounting process, okay? Because I had a hard time thinking about, every time I hear the word adjust, I think we're fixing something. No, it's correcting means we're fixing something. So this was this one, right? So I think we got through this. Anybody have any questions over that? Okay, all right. So this next one, I went to a little more trouble than I have before, but that's okay. All right. Let me put this in front of you. So this goes with number 5. Okay, so this is 5A. There, okay, and I need to hand it to you. All right. So you're gonna get two things now. Look out now. So here is this, and then you're gonna get T account sheets. So you get to write on these, hopefully in pencil. And you're gonna get to keep track of what we've done. So I'll explain. So you should have 3. This is page 1, page 2, page 3. So everybody should have 3 T account pages. I got it. Here's the problem.
Thank you.
Yep, and then here comes your page 2 and 3. Okay, and I'm gonna explain what this is. If you can figure it out, that's cool. But let me explain what we've got. I think this will help. I just gotta find your 2 and 3 here. Okay, and 2 and 3. So if you'll spread that out, so you can see all 3 pages across your desk, I think it'll help. All right, so here you go. And then here are your 3 T account pages. So you don't have to make any accounts. You're gonna get to write right on there. All right, so we're gonna use these T account sheets. I create these in Excel. And we're gonna use these T accounting sheets like they're the ledger, okay? So we can keep track of the balance. There's 2 of them. Can't get my finger on the 3rd one. So if you'll just line them up. So this is 1, 2, 3. Okay, here's the problem. And 1, 2, 3. We'll line them up. And I think you'll start to see what I've done here. If you look at the first T account page, the first one is cash. Okay, look at cash. And look at the balance that this problem says cash has. It should be reflected in T account sheets. Everybody see it? Not yet. I've got them all out. I got it. So cash right here should have 27,500. What does that say? 27,500, right? So what I've done is I've created these T accounts with their current balance. So all these balances you see. Oh, I may have given you 1 too many. Really? Good Lord. Okay. All right, so here's 1, 2, 3. Here they go. So once again, we're starting with cash. So all your assets are listed and their balances. If you wanna audit, make sure I put in the right amount. I don't mind. Okay, there's 4 accounts that have nothing in it, but we're gonna be using them as we make our entries. Okay, so I'm gonna go to 5 now. Everybody's got their sheets. Hopefully, all right, and we're gonna walk this out. Okay, let me go to, and I've got it up here in my spreadsheet here. So hang on. Okay. Okay, so what I need to do is put in my balances into my sheet here. I've already put it in the balance that I have given you. Okay, so now let me go to number 5. Oh, I forgot to check my work. Did I miss something? Did I miss answering a question? There it is. I forgot to do that. That was the last one and I got too excited. Okay, now let's go to 5. So this will be like the one you'll need to do. All right. So let's see if we can't make this happen. And we just have to general journal, but we're also going to have to keep track of what the balance is in the accounts, because when we're finished, we're going to make an adjusted trial balance. So if you want to make your adjusted trial balance, get rid of it for now. Let's just do instructions, chart of accounts, and general journal. Okay. So, let me go ahead and put a couple things in. This is Premier Editing Company. It's a small editorial service company. This is for the year ending August 31st. So we want to go ahead and make sure that we know we're working with year end August 31st. Year end, August 31st. So that's going to make all of our entries be August 31st as a date, right? Okay, so what I'm going to do, and I've got them in red, I'm going to go ahead and put these in. You should, and if you want to just take a look real quick before we go any further, here's cash. Here's accounts receivable. I put an A next to an asset. If you see CA, that's a contra asset. If you see an L, that's a liability. If you see an E, that's an equity. If you see an R, that's a revenue. Now, I didn't put an E next to expense. I just put expense there. Okay, so here's what we have. We have cash. And it has a beginning balance of $27,500. Everybody okay with that? Okay, my beginning balance in accounts receivable is $68,400. So I'm going to do this. I don't even remember why I made this red, but I want to, oh, I know why, because that's an account you don't adjust. Okay, that's an account you don't adjust, but that red really makes it look violent, so I don't know why. So I'm going to turn blue the ones that we aren't going to adjust, okay? But we will be adjusting accounts receivable, okay? So an account that has an amount we are going to adjust, I just left white, okay? We'll come back to what that adjustment will be and a new balance here in a minute. So now I'm going down to prepaid. My prepaid insurance should have $7,200 in it. Yes. My supplies account should have $1,980 in it. Yes, it does. My land should have $112,500. There is not an accumulated depreciation for land. Okay, there is not. There never will be. Because we don't know how long land is going to last. So if we have a land investment, we don't expense it. We just have it. Okay, so let me change this from red to blue. Okay, so, and same with the building. Building is not adjusted, but its accumulated depreciation will be. So the building is $150,250. So far, I think we're okay. Here is the accumulated depreciation that goes against this building. I'm sorry that I've got them not on the same line, but the accumulated depreciation should be $87,550. Yes, that matches what we have. The equipment should be $135,300, and that will not get adjusted. So I'm going to make that blue. Its accumulated depreciation that goes against the equipment should be $97,950. Okay. Accounts payable. Accounts payable has $12,150 in it. We are not going to adjust it. Now, there might be a reason to adjust it, but in this problem, we're not going to. All right. Our unearned rent, $67.50. Okay, $67.50. So that's a good balance. Our common stock has 100,000. So like I said, the last time I did this, they had different numbers in, and I'm just changing what I have in my spreadsheet. Okay, so fixing it up. Retained earnings. Retained earnings has 171,000. Make sure that I have that in there correctly. Make sure it's the credit side. Okay, credit side, retained earnings. Dividends. Dividends has 15,000 in it. Now it is an equity account, but dividends is never adjusted for a month end. All right. Okay, fees earned. Yep, fees earned definitely is a candidate to be adjusted. And fees earned should be 324,600. So that seems to be right. Okay, now we're about to go into expenses. Okay, usually your expenses have the most number of accounts. So I've got a salaries and wages expense of 193,370. So that is matching what we have here. Okay, then we have a utilities expense the 42,375, let me color that blue, because we're not gonna touch anything with blue. My advertising expense is 22,800, we're not touching it with any kind of an adjustment. My repairs expense, 17,250, nope, we're not doing anything with it. And then miscellaneous, nope, I've never seen miscellaneous adjusted, never ever. But you should have an account that says insurance expense somewhere on your sheet, and it has 0 in it. So if you want to take your pencil and go to insurance expense and put a 0 there, that's letting you know that there was nothing in this to start with. Okay, so I'm going to insert here and put 0. We got a 0 in insurance expense and a 0 in supplies expense. There was nothing in those accounts until we're going to make an adjustment. All right, the depreciation expense, there's one for the building and one for the equipment. Let's put zeros in those too. Okay, so we start with a 0 balance and we have a 0 balance. Okay. You should have a rent revenue account somewhere next to your fees earned, I believe. It's going to have a 0 in it, so put a 0 on the credit side. It started with 0. And then your salaries and wages payable is also going to have a 0 on the credit side to start with. Okay? How are we doing?
So the rent revenue and what else started?
The rent revenue will have a 0, and it should be a credit side because revenues go up with a credit. Your liability, it's called salaries and wages payable. I may have abbreviated a little bit, but it should be with the rest of your payables. It's going to have a 0 balance. Okay, so you've got the ledger sitting right there in front of you. That's all the account balances that we put together for this is, what is this one called? Unadjusted trial balance, right? Unadjusted trial balance. So that's what you're seeing on your sheet of paper right here, right? This is the unadjusted trial balance. We added about 6 accounts, I think, that have zeros in them because they're going to get used as we go through making adjustments. You don't show an account in a trial balance that has a 0. You don't usually show it. Okay, I would, just for simplicity's sake. Okay, all right, so here we go. Here are the adjustments. I'm going to read them. We're going to analyze them, trying to figure out what T accounts we're going to use. Remember, we're not going to use anything with blue in it, right? Cash does not get it. You know, if you want to put some notation there that says do not use for the adjustment, right? Whatever you need to do. Okay, let's get started. The first one says unexpired insurance. Unexpired insurance. So the first thing I would do is look. Do we have an insurance account? Yes, we have a prepaid, right? A prepaid insurance account. Unexpired is the ending balance in this prepaid insurance account. So at the bottom of your prepaid insurance account on your T account, put the amount of $1,200. $1,200. Okay, we're putting this in so we can figure out what the adjustment has to be. Okay, so let me calculate that now. So if insurance still has $1,200 in it and it started with $7,200,
Be 6 grand.
be $6,000. So down goes prepaid insurance. with a credit of 600. And if you'll now go down to your insurance expense account, which I think has 0 in it, if my memory serves, it's gonna get a debit of that 6 grand. Okay, so now we're ready to put in our journal entry, right? So let's go down to the journal and let's put the date. Where are we? August 31st. So we're at August 31st, and what are we debiting?
Insurance expense.
Perfect. Good job. You remember. Insurance expense gets that debit of 6 grand, and prepaid insurance gets the credit. Because that's the asset going down.
Over.
What now?
Oh, I was just
Okay.
talking to myself.
That's all right. I do that all the time. All right, August 31st. That's our next entry that we're gonna put in, so we might as well put the date in. That makes us feel good. We got something right. Okay, so we just made our first adjustment. If you want to put next to that debit in the insurance expense account, adjustment 1, that might be a good idea, right? So back up here then in the prepaid insurance account, I put adjustment 1, right? So if you ever have to go, well, what account, so you know, right? So what is your new balance now in prepaid insurance? We put $1,200 in there, didn't we? Yep. So when we report the new balance in prepaid insurance on our adjusted trial balance, we'll use this amount for the balance. Okay, so just to kind of get you thinking that way. Let's go to the second one now. Now we're talking about supplies. Right off the top of your head, do we have 2 accounts that have the word supplies in it? Yep. One's an asset, one's an expense. Okay, so I'm going to go down to the asset account, which is supplies. It started with 1980. They said supplies on hand. Supplies on hand is the balance in it right now. So I've got $280 is the balance in supplies. So I've got to figure out how much went out. So if I take 1980 and subtract 280 from it, then 1,700, very good. So we are making supplies go down with a credit of $1,700, and that is adjustment 2. Okay, adjustment 2. So then we need a debit to the supplies expense account, which I think has 0 in it. There it is, of 1,700. Okay, 1,700. Now let's do our journal entry. Okay, let's do our journal entry. We already put the date in. So we're debiting supplies expense. Wow. 1,700. And we're making the supplies asset account go down by the amount of supplies that we used for this year. Okay. So there is our second adjusting entry, August 31st again. August 31st again. All right. Number 3. The third and the fourth one will be very similar. One is depreciation on the building and one is depreciation on equipment. Let's do one at a time. So we don't have to figure out the number. They're giving it to us. So depreciation for the building. Go to depreciation expense building. This is going to be your adjustment 3. And I've got $10,000 is the amount for that debit. What are we crediting? The accumulated depreciation for the building. So be sure you're using the one for the building, not equipment. Okay, you gotta make sure to watch that. So in your T account, which should have 87,550 in it, we're gonna add 10,000 to it. Okay, don't worry about the balance yet. We'll figure those here in a minute. Don't get caught up and get off track. Okay, let's put our entry in. So go up to the chart of accounts and find depreciation expense for the building. Or if you want to type it in, that's perfectly fine. I'm going to be lazy. Okay, they said it's 10 grand. And the credit goes to that contra asset of the building. Accumulated depreciation. Okay, for 10 grand. All right. We're going to turn around and do that again, but this time for depreciation for the equipment. So we want August 31st. Now we want to go to depreciation expense equipment. There it is. And they're saying that it is, now I got to find it, so just lost it.
6,000.
Yep, okay, same as last time, that's good. 6,000, thank you. So we're gonna debit that expense account. If you wanna write it in, it helps you see it in the account that we are putting it, right? So now we're going to put depreciation expense equipment in as the debit to create that expense. And then it accumulates in accumulated depreciation equipment every time we make an adjusting entry. Okay, so we've got 4 done. You should be ready for line 10 of your journal. Line 10. Luckily, I can't recall an adjusting entry that takes any more than 2 accounts. Okay, it's always going to be one balance sheet account, one income statement account. And we'll go back through these and check our methodology here in a minute. So August 31st is the next one. It said rent unearned. Now this one we have to calculate. Okay, so we're going to go up to unearned rent. It is a liability. Unearned rent. Here it is. Unearned rent. We said it had a balance of $67.50. Everybody confirm that. Confirm that on your sheet. Now, what they're telling us is that the rent that's still unearned is $12.50. Okay, so we're going from $67.50 down to $12.50. So we're going to have to figure out how much this adjusting entry is going to be. So $67.50 minus $12.50 is $5,500. Okay, so we must have earned that much rent. So we're going to get rid of it out of the liability. So now the liability has a new balance. But when we make this debit, we must credit rent revenue for $5,500. Okay, so let's recap what we did. And this is our adjustment 5. So we debited, right? We debited unearned rent because they gave us and this one's hard. They gave us the amount of unearned rent that still is there at the end of the month. So we had to calculate what the adjustment is going to be. Unearned rent. And wow, I still have nightmares about trying to understand this. Okay, we got a 5,500, and then we're going to show that rent revenue is good now because the time must have passed for that to be recognized, and we want to recognize revenue just as soon as we can. Okay, but not before. Okay, so that is number 5. So we're ready for the 6th adjusting entry with another August 31st. Okay. And if you want to put numbers beside these, I don't know why they didn't put numbers beside each of these adjustments. I don't like that dot. That drives me crazy. I like my stuff numbered so that, geez, oh well. All right. This one says accrued salaries and wages. So if you look at accrued expenses is what we're going to work on. So we need to make an expense happen that includes a liability going up. So I think we have a salaries and wages expense. Okay, so go to salaries and wages expense. It has nothing in it to begin with. So the amount we need to expense is $9,000 according to the sheet. Okay, so we're putting that, I'm sorry, I put that in the payable first. Let me start over. Go back up to salaries. It is an expense that already existed. Okay, yeah. Okay. Where did, oh, here it is. Salaries and wages expense already had 193,370 for the year. We're going to add 9,000 to it. The debit, right? Now let's go put it in the payable as the credit. So this one, I don't think has anything in it, but it does now. It's going to get a credit for 9,000. So now let's put our journal entry in. So we want salaries and wages expense. So let's go find that expense so we don't have to type it all in. And in accounting software, you would actually pick the name of that account, right? And they said 9,000 needs to be accrued. 9,000 needs to be recognized as an expense, but we're not ready to pay it out yet. Okay, so what are we going to do? We're going to put it in a payable. So we go to salaries and wages payable, which is sitting here, and put that in as the credit. Okay. Last adjusting entry, August 31st. Okay, last one says fees earned but unbilled, right? So we need to bill some customers for 15,000. When we bill customers, right, accounts receivable will go up. So way up here, here's our very last entry. This is adjustment 7, right? So we must have found a job or two that we need to bill our customers for. And when we bill them, we'll recognize the amount that we're billing them in accounts receivable. Okay. And when we debit accounts receivable, we will credit fees earned. Okay, fees earned is our regular revenue account. There it is. So that adjustment is the last adjustment. It's number 7. It's going to credit fees earned. Fees earned already have 324,600 in it. Okay, so now let's do our entry one more time. Accounts receivable is what we're debiting when we send out bills to customers. Okay, accounts receivable, 15,000, and fees earned. So that entry from the book is called accrued revenue, fees earned. Okay, let's put that in. Okay, does anybody need this bigger that you can see it better? Everybody okay? You okay? You need it bigger?
Yes.
Okay. Okay, is there an entry that you need a little help with? Whoop, I made it the wrong way. Is there an entry that you need any help with, why we debited, why we credited something? And I keep losing my journal here okay, so here's what we're looking at. What's the rule about adjusting entries?
Can you go down one
I
more?
can.
please? Sorry.
No, you're good. So while you're looking, there you go. While you're looking, we're gonna go back through these a minute. Okay? So I said that every adjusting entry will affect one income statement account and one balance sheet account. So what's happening in that first adjustment is an expense is going up. That's your income statement account. An asset is going down. Okay, so that is affecting one income statement account, one balance sheet account. This is one income statement account, one asset, one balance sheet account. Okay, the expenses will always go which direction? Up. Every adjusting entry, if it involves an expense, is going to cause it to go up. You're never going to see an adjusting entry that causes an expense to go down. That would be a correction. Okay, like if we put something in the wrong spot, right? So here's an expense going up, an expense going up. Now you say, well, this is contra assets. Yes, but the contra asset actually makes the real asset go down. So I know it's kind of hard to chew on, but it'll be all right. This unearned rent is a liability. Time must have passed, and they told us how much rent was earned, or they told us how much the ending balance in unearned rent is. So sometimes you got to find an amount, and sometimes they just give it to you. But this causes revenue to go up. So if revenue is involved, which this one is revenue and this one is revenue, all the credits to revenue cause revenue to go up. So the only direction that adjusting entries do to revenues and expenses is cause them both to go up, depending on which one's being used when. Okay? The other thing is, it just depends on which one you're working with, right? There's an asset. It's going down. Here's an asset going down. Here's an asset going down. Here's an asset going down. Here's a liability going down. Here is a liability going up. Here is an asset going up. So it just depends on which one it is. Okay, so we're going to hurry and get this done now. We're going to let my Excel spreadsheet help us. Okay, go open that go open that adjusted trial balance. Now, go ahead and open that. I'm going to close the instructions, and I'm going to close the chart of accounts. I'm even going to close the journal. All I want to do, this is where your T accounts are going to come in handy. Are you ready? Okay. The good news is they've put all your account titles in for you. That's nice. So you don't have to put those in. All you have to do is now look at your T accounts, right? Look at your T accounts. I got to find mine here. I'm on the wrong one. Here we go. What's the balance in cash? What's the balance? Did we adjust it? So it is exactly what you see on your T account. It's $2,500, right? That's it. It was not touched when it comes to adjustments. How about accounts receivable? Accounts receivable, if you look at it on your T account, and I'm looking at it on here, right? I'm looking at it. If you followed along, you should have made an adjustment to that. That was actually adjustment number 7. Should have made it go up $15,000. So the new balance in accounts receivable should be $83,400 if I've got my stuff in there right. Okay, and I think I do. Right? So what's the new balance in accounts receivable? 83,400. You have to make sure you're on the normal balance side. What are all these? These are all assets. And they're all going to be on the debit side, except for these contra assets are going to be on the credit side. So watch it. Okay. Let's go evaluate prepaid insurance. Look at prepaid insurance. It has 7,200. You should have made an adjustment to it to make it go down 6,000. That's adjustment number one. So the new balance in prepaid insurance is what? $1,200. $1,200. Supplies is right next to it. Supplies started with $1,980. We made an adjustment to it of $1,700. So now its new balance should be $280. How about land? Did we adjust land? Nope. Didn't adjust the building either. So just put in whatever that balance says in that T account. Okay, just put it in. Okay, and like I said, I'm trying to get rid of the decimals in here so that you can't see them. Because luckily we don't deal with coins in here, thank God. All right. So we've got accumulated depreciation. So let's go make sure, here is accumulated depreciation for the building. We had a beginning balance of $87,550. We added depreciation to it of $10,000. So now its new accumulated balance is $97,550. Okay. Be sure to put that on the credit side. Go back across. Equipment. No, I did it right. Okay. I thought I put the wrong one in. Equipment. We did not adjust. It's $135,300, but we did adjust its accumulated depreciation. So if you look at the T account for accumulated depreciation equipment, it's starting with $97,950. We added $6,000 to it for adjustment 4. So now we should have a new balance of $103,950. Okay? $103,950 is the new balance in accumulated depreciation. Okay, we're ready to put accounts payable in. It was not adjusted. All right, accounts payable was not adjusted. It just goes in as a credit balance of $12,150. Unearned rent. Yes, it was adjusted. We started with $6,750. We figured out, or they told us that we earned $5,500. So now we have an ending balance in this liability of $1,250. Okay. Our salaries and wages payable. I put you guys as right next to the other payables so that you could find them together. You had nothing in it to begin with, but now you have a balance of $9,000. So let's put $9,000 in as a credit. Okay, here comes some equity. Equities do not get adjusted. Our equity has $100,000 in common stock. Make sure it's on the right side. Our retained earnings has $171,000. Our dividends, go back across. Dividends has a debit balance of 15 grand that did not get adjusted. Okay, we are now ready to put our fees earned in. Okay, are you on your way out? Okay, thank you very much. I'm going to go ahead and post this video out just as soon as we're done. All right, here we go. Fees earned has $324,600. We added $15,000 to it. So now its new balance is $339,600. rent revenue. Okay, rent revenue had nothing in it, but now it has 5,500 in it. So let's put 5,500. Now let's go back across to the debit side, and that's where we're gonna stay. Okay, that's where we're gonna stay for the rest of this. So salaries and wages expense, I'm gonna pick up the pace a little bit. Salaries and wages expense started with a balance. We added an adjustment of $9,000, so now we have 202,370. Okay, utilities expense was not adjusted, so you just simply put the balance in. Advertising expense was not adjusted, just simply put the balance in. Repairs expense was not adjusted, just simply put the balance in. Depreciation both had zeros in them, so you just put in whatever the entry was. So the building is 10,000. Thanks, John.
Let's see.
Okay. And then 6,000 for the depreciation for the equipment. Insurance expense didn't have anything in it, so you just put in the adjusting entry. Supplies expense didn't have anything in it, 1,700. Miscellaneous, we did not adjust it, but its balance should be 6,750. Okay, so I'm gonna save you some time. Okay, let me see if I can add these up real quick. Just a minute. I will put these in because I put these in another time. So we got 27,500, 83,400, 1,200, 280. 112,500, 150,250. I'm just double checking. Huh? Yeah, did you already figure it? Oh, it's got the check answer, doesn't it? Okay, well, all right. So when I get finished putting this in, what does the check answer say? 840,000 is, so, yep. Okay, so if you trust it, that's fine. But I'm gonna go ahead and put my figures in because I like to see that it really worked. Okay, so that's it. All right, that's it. I've been recording, so I'll put this recording out there for anybody who needs to go back to something. All right. So like I said, I'm gonna go ahead and finish. If you want to go ahead and go, that's just fine. Okay, so I'm putting in the rest of this to see if it works. I don't trust everything what it says it's doing. And you should be that way too sometimes. So, all right, guys, we made it through. Thanks, you guys on Zoom. Okay, glad you made it. Okay. So I have miskeyed something and I'll find it eventually. Okay, so I'm gonna go ahead and go to this side. I'll find it. All right, so like I said, if you're done, you can be on your way. Thank you for coming in, for lasting. All right, and so the only one you should have to do is pretty much the one like what we just did. Okay, so
And it should be set up the same way as this one, it's different.
just different numbers. Yep, so if you want to use the T accounts or whatever, I don't think you could go wrong. I know it seems like a lot of extra work, but I think,
It did help.
I'm glad to hear that.
It does help with you, right?
Of course it does. Anybody who says it doesn't. Bye. Or just doesn't understand it at all. You know what I mean? So on big problems like this, we're gonna do this. Okay, we're gonna use this. I find this very valuable. In fact, I have an Excel spreadsheet that has nothing but blanks. So I could put anything I want to in there, works out nice, right? Makes it legible. You can do whatever you want to with it. Yep. So cool. I'm glad you like it. Because I know I couldn't do it without.
Bye.
Okay, bye. Thanks for coming in, Mr. Gates. See you later.
Yeah.
Thanks for staying. Okay, hey, I got one side balanced, okay?
It's 6,075.
6,075. Whoop, I just miskeyed it. Hey, whoop. All right, we did it. Let me put my answer in and then I get my gold star, right? Okay. Daniel, you doing okay?
Yes, ma'am.
Hey. Good. I didn't see very many glassy eyed looks.
No,
Pretty darn good.
yeah,
Good.
the only thing I have issues with is the balance sheets and whatnot. Everything else,
Seems
like,
to flow.
like 1 through 3 and then like the last 3 or whatever.
Uh-huh.
Those small, like, word problems, maybe the smaller ones are a lot easier for me,
Sure.
so.
Well, and I was gonna leave those for you, but I kind of wanted to start us off a
Yeah,
little slower.
Yeah,
You know, so, okay. Okay, guys that are on Zoom, thank you for being here. I appreciate it. I gotta stop my recording so that I can. So now I don't have to record.
what's the number of absences that we are, I guess,
Oh,
allowed to miss?
well, hang on just a second. Let me stop my recording.